How's it going, everyone? My name is Derek Afasi. I'm the owner of Afasi Financial Group. Today's topic, I want to get into the discussion, are annuities safe, and fully explain when an annuity can be a correct fit, and then many times when an annuity is not correct for a specific situation. So the very first bullet point that I go over is I say safety versus investments for your situation. Understand that you could have annuity set up in a very safe way, meaning you could have it on a fixed basis where whether it's IRA monies, retirement monies, qualified retirement fund monies, or just regular cash accounts such as non-qualified accounts, you could place both of those types of accounts into an annuity contract. So if you have somebody that has an IRA contract that has been accumulating their money, has tied that into risk for a majority of their life, and now they're getting ready for retirement, they could go and take this IRA and transfer it into an IRA annuity. Or if they have a 401k, they could go and roll over that money into an IRA annuity. So it's going to still stay on the qualified retirement side, but now you have certain benefits with setting it up with an annuity contract that could be much safer than what a typical IRA or typical 401k provides. What I mean by that is if we're just going off of the very first basic type of annuity, a fixed annuity or a MIGA annuity, what happens is it's going to act kind of like how a bank CD gets credited. It's just going to be a fixed interest rate year by year by year. So if you're in a 5-year product, for example, and that 5-year product is paying you 3% rate of return, well, unlike a bank CD that's only paying you on simple interest 3%, so if you have like a $100,000 deposit, with a bank CD, that would be paying you $3,000 each year for those first 5 years. With an annuity, you could actually have tax-deferred growth, meaning it will be 3% of 100,000, which would be 103,000. Then the next year will be 3% of that number. The next year will be 3% of that number, etc. But understand that it would just be a fixed interest rate. So if the market goes down, if mutual fund performance goes down, unlike with a 401k or a traditional IRA that's set up with those mutual funds, this fixed annuity will just provide you a fixed interest rate. But therefore, on the opposite end of the spectrum, if the markets go up, well, then this 401k and that traditional IRA that was tied to those mutual funds or the stocks, bonds, whatever the case may be, that would be increasing more in value. With this fixed interest rate, would stay exactly fixed. So that's yes, it's a very safe alternative, and many seniors start to flock towards annuities, especially right when they become a little bit above the age of 50, age 55, to conserve their accounts, to preserve it, make sure that it's protected from any downward market losses and high amounts of fees. So that's why they might choose an annuity contract for that safety aspect. So anytime that you're looking at a specific situation, you have to determine, is this a safe contract or is this an investment contract? Because just like how I mentioned above that you could have qualified funds or non-qualified type annuity contracts, you could also set this up in an investment realm such as a variable annuity. What a variable annuity does is their accounts are tied to mutual funds, and they typically have very high sets of fees associated with that as well. So you would have to be paying certain fees and also be susceptible to downward market losses, as opposed to a safe annuity such as a fixed annuity. Now, one of the more recent annuities that became very popular is you have the hybrid annuity, which is a spin-off off of a fixed index annuity. It's just simply a fixed index annuity with an income rider. And what that does is that same sort of concept as a fixed annuity, giving you an interest credit year by year, but what determines whether that interest credit is going to be positive or is going to be 0% depends upon what sort of stock market index that you chose with that specific product line. So that would also be considered a safe type of annuity contract as opposed to a variable annuity, which will be risky. Such as safety versus investment. So the best way to determine whether something is a safety account, such as a bank CD, such as a fixed annuity, such as a fixed index annuity, such as a hybrid annuity, all those different sorts of aspects are, if the market goes down, is your annuity account going to lose value, or can you get a negative credit to your account? If, let's say, the market goes down and you're set up in an investment, well, if that investment could go all the way down to zero, that's the major difference of an investment. So when you're planning out for your retirement, it's always good to be mindful of, okay, how exactly am I structuring out my monies the proper way? If you have a specific goal, and that's why I say how to set up an annuity properly, annuities could be fantastic vehicles, fantastic retirement vehicles, But you have to make sure that you're setting up the right way. There's many times that people go into annuities blindly because you have thousands of different options available off of annuity contracts, and in reality you should only be choosing about 5 to 10 different options that could suit an individual situation. So with that being said, you have over 900 different options or thousands of different options that are actually not going to be suitable for your specific situation on the annuity planning. So one of the most important takeaways that you get from this video or any other video out there is to try to control your income sources. Okay? If we understand that you're going to have specific expenses each and every year, then the trick is to learn how to segment those expenses properly to make sure maybe you might have fixed expenses that are going to be costing you $30,000 a year. But then you might also have inflationary expenses that might be costing you $10,000 a year. Well, if you're looking at all of the different monies that you saved up for retirement, any sort of investment, any sort of cash flow, anything that's producing some sort of cash flow, how exactly can you match up that income source specific to what your expenses are? So what I mean by that is many times somebody would look at Social Security as leveraging that as part of their expenses. So let's say Social Security, in this example, we understand this person has fixed expenses of $30,000, and then they have inflationary expenses of $10,000. So when they retire, they have a starting expense number of $40,000. With Social Security income, maybe this person's receiving $20,000 of income. Another fixed income source could be a pension plan. Now, unfortunately, many individuals are not offered pension plans, but the ones that are, let's say that this individual now has $10,000 that's coming to him of a pension income as well. So now, between the two of these, we have $30,000 of income. If the expenses are still $40,000, well, then you could leverage a type of financial product, financial tool, think of it as a financial tool, as a type of annuity contract that will provide you lifetime income for that additional $10,000. So the best way on how to set up an annuity properly is to go and dissect all the different companies out there to see which one would suit your needs. Whether you're looking for income for both you and your spouse, basically single life only income. How exactly do you want to structure that annuity properly? Do you want to leverage old 401k monies, IRA monies? Do you want to use cash accounts from a business or a house that was just recently sold? And when you determine where you want to pull those monies from, it's all about making sure that you're leveraging the smallest amount of dollars with specific annuity contracts that will produce you, in this case, $10,000. So the biggest mistake that's made is an individual would go and say, oh, I have $500,000 that's sitting in an IRA account. Let me go and roll over that entire thing into an annuity contract. Well, if you don't need $500,000 worth of an annuity, don't go into an annuity, because annuities still have restrictions. The company, yes, is giving you a max cash flow, they're giving you max income, but they're also going to restrict your liquidity. You could also have certain cap rates and spread rates, things that could restrict the growth on those specific types of accounts. So in this situation, let's say the individual has $500,000 in their IRA, well, maybe it's only going to cost them $150,000 of an initial deposit to place into company XYZ that will produce them lifetime income starting in 30 days or starting in 2 years, whatever that case may be, as opposed to company ABC, which requires for that same $10,000, 200 grand. So if these two companies are the same exact quality, utilize company XYZ that would be able to produce you that $10,000 at a much cheaper price, and you'll be able to set $50,000 extra dollars in your pocket or throw that into the market, because now you could risk those monies properly. So the very last bullet point, let me clear up this, is max income through riders, not annuitization. Now, when annuity contracts were originally set up, you had this, or you still do, with every annuity contract, they give you a form of an annuitization where you could take out life-only income payments or period certain payments where you're surrendering your entire value, your entire account value. In that case before that I was speaking about, $150,000, you could surrender all that money to the insurance company and they will provide you a set income stream. That's known as annuitization. I absolutely hate annuitization because I believe that you lose control when you annuitize your contract. So there's ways when you had more innovative type products that came out that allow you to still control your monies, still grow whenever the market goes up, not lose anything whenever the market goes down, so that you're utilizing that safety play, but then trigger lifetime income through something known as a lifetime income rider. So the lifetime income rider is completely different than an annuitization. The income rider And the combination between the actual account value, your indexing strategies, meaning how much growth you could receive off of your physical money, and the income rider that will provide you lifetime income would determine which contract is good or which contract is, excuse my language, crappy. So you just want to make sure that you're setting them up like a perfect, like an individual tool in a tool belt. If you're going to have to hammer in a nail, you're not going to use the back of your screwdriver to hammer in that nail. It's more effective to use a hammer. That's exactly how you have to look at your retirement. If you have specific categories that you need to have accomplished, you want to make sure that you're using the correct tool to accomplish those categories, to make sure that you have that peace of mind that you could do whatever you want to do in retirement. If that means visit your grandkids, or that means fishing every day, if that means golfing every day, whatever that case may be, so that you don't have to worry about the financial aspect, that's how you can use an annuity properly. One of the biggest mistakes that are made with annuities is when you're trying to use it as an investment when it should only be used as a safety vehicle. And you hear different things online where you have people that bash annuities, and a lot of what they're saying is completely justified because they're always talking about the return, the return, the return. You will have safe, consistent return on your monies, but the main reason why you're leveraging the annuity contracts is for that income play, for that max income play. Because if you're using an income sources, like I mentioned before, and I say, okay, Social Security income will bring you 30,000. Pension income will bring you, or sorry, Social Security income will bring you 20,000. Pension income will bring you another 10,000. And now you have a $10,000 expense over there, a $10,000 gap. Well, if you're going and you're trying to suffice this gap with investments, well, then you fall victim to something known as reverse dollar cost averaging, which states that as long as, let's say that account, the same $150,000, we'll just use $100,000 for this example, if you're throwing that in regular mutual funds and you're having that monitored through a financial advisor, well, those mutual funds are going to come with a cost. That advisor is going to come with a cost of something known as a wrap fee. That account is still going to be susceptible to downward market losses. You're going to be pulling out this money. And then on top of it, you still have to have a plan for inflationary protection as well. There's ways on how you could it's known as a laddering strategy, where you could actually ladder up your annuities to make sure that you're triggering income, let's say in 30 days or in 2 years, whenever you want to retire, and then every few years you're triggering off different income riders to make sure that you're stepping up in income, stepping up in income, stepping up in income, so that your ultimate goal is using the smallest amount of dollars, but as much as necessary to accomplish what your income goal is at the end of the day. So if you found value in this video and you're trying to figure out with your specific situation how to leverage your max income planning properly, give our 1-800 number a call. It's 1-800-566-1002. We offer 24/7 customer service. You give us a call mornings, nights, weekends, holidays, whatever the case may be. Someone will be standing by to take your phone call, and we'll patch you over to a specialist. From there, that specialist is going to educate you first and foremost to see whether or not an annuity may be right for your situation. There's many times that annuities are not right for the person's situation, but you want to be educated on that. With retirement, you only have one chance to get things done correctly. You do not want to make a mistake, and you definitely do not want to risk that money into the market and risk it towards an investment if an investment is not necessary, because if an investment goes down, if your money goes down, well, then you're going to have to work that many more years just to gain back all of that money from something that could have just been placed in a safety vehicle, something that could have received contractual guaranteed income, lifetime income for both you and your spouse, and set it up successfully. We try to show these strategies. We try to speak in very simplistic terms and send you literature pieces, video content, all of the above, to make sure that you're fully educated throughout the entire process. We are A+ rated on the Better Business Bureau. We've always had very good reviews. We've never had any complaints. It's because of this methodical process. I want to thank you very much for watching this video. Please feel free to subscribe to our YouTube channel, Retire Sharp, so you can have access to the most updated videos. Thanks so much, guys.